Bill, three-part act, we've wrapped it up. We've had the forecast, the decision, and now the news conference. What's your reaction to all of the above?
Well, I thought the summary of economic projections was actually a bit hawkish in the sense that they downgraded growth and pushed up inflation. And the dot plots, the dot plot did sort of shift up. They didn't shift up enough to change it from 2 to 1 rate cut this year, but it did shift up. Powell then came in and I think gave a pretty dovish performance in the sense that, we got this. We're in a good place. We can afford to wait. We'll see how it goes. We're going to get the job done. So he, I think, was pretty reassuring to people that this was all, quite manageable. I think the reality is, the growth outlook is worse, the inflation outlook is worse, and uncertainty is a lot higher. I'm not really sure how you parse that out as positive, but Powell put a pretty dovish spin on it.
Bill, that's where transitory comes in. It was resurrected, the word that was once left for dead, thought to look through some of the tariff-induced inflation, saying it probably would subside. What do you make of that? Because it's giving a lot of confidence to this market.
Well, one thing that he did talk about was inflation expectations, and he basically said, look, there's only one indicator that's really shown a significant increase in long-term inflation expectations. Everything else looks fine. So he's basically telling people you can ignore the University of Michigan long-term inflation expectations measure, which has shot up very sharply the last month or so. So that's reassuring. So I think people think Fed's got this. I think the reality is they're flying blind. They don't really know what's going to happen to growth. They don't know what's going to happen to inflation. And that increases the risk of making a policy mistake or just being late.
There's a book years ago, Bill Dudley, with a chapter by Bill Dudley and Ed McKelvey, and you said off of Patrick O'Brien, there's not a moment to lose. How exposed is this Fed? They're, to me, not a moment to lose. They are wait, wait, wait. Isn't that their best outcome?
Well, I don't fault them for waiting. I think when uncertainty is really high and and the economy is in a pretty good place. Inflation rate's running 2.5%, 3%. The unemployment rate's around 4%. Staying here, indefinitely would not be a really bad outcome. So I think that's what gives them the ability to wait, because the starting point is actually pretty good. The other thing I thought was interesting about Powell's remarks is he started to minimize the soft data that's showing a lot of weakness, and said we're really sort of focusing on the hard data. We haven't seen weakness in the hard data yet. So that was also reassuring.
This is what Marko Kolanovic, formerly of JP Morgan, has to say out on X this afternoon. Not in a hurry means we will drag our feet when things get worse, like in the fall of 2018. This is not bullish at all. Bill, you've lived a lot of this in the past. Is there a risk of a repeat of 2018 here?
Well, I just think there's a risk that the Fed will be late, because if you have to have the information in hand before you act, and there's long and variable lags of monetary policy, then you're not going to do the necessary action in a timely way. I think but at the same time, which way does the Fed lean? Do they lean against the inflation, or do they lean against the growth side? I thought it was interesting, the summary of economic projections also didn't get a lot of attention, but people's assessment of uncertainty about inflation and employment both went up. Their assessment of risk to inflation and employment both went up. And I think that's really what tells you what's bad about the economic outlook now, is that this dispersion of possible outcomes is pretty wide, and we just don't know which way we're heading.
Bill, you said that this is a Fed that's flying blind, and essentially Fed Chair Jay Powell said as much when he was asked why there was this ongoing 2 rate cuts priced into a market where you had some pretty sizable changes to growth and inflation. And he said, what would you write down? It's really hard to know how this is going to work out. Is there any time in history, Bill, that you can think of where the Fed was as flying blind as they are right now?
Well, I'm sure there have been other times. For example, when you had the 2 oil price shocks in the 1970s, that wasn't very good. You had the great financial crisis in 2007, 2008. Lehman Brothers failed over the weekend, and then the Fed was meeting the next Tuesday and Wednesday. So that was probably a pretty flying blind moment. So I think there's been other times like this. The good news is that your economy, as Chair Powell made it clear, is starting from a pretty good place. And that's the important part.
John Farrow, David Rosenberg, just out on Twitter right now, really has, and this is the insight that I had with Bob and Michael before, a 4.4% unemployment is a single stick, 100 basis points above the 3.4% low. You got to go back to 1948 to see that abruptness without a recession.
So we had some deterioration last
underplayed.
summer, Tom. I'm with you, but it turned out to be a head fake.
Yes,
and the Federal Reserve was somewhat unnerved by it going into Jackson Hole and signalled some reaction to it, Lisa, and they followed up with 100 basis points of interest rate reductions, and here we are again. And we're trying to figure out if the soft data and the deterioration we've seen in the survey data is a head fake or not, and whether it will translate into softer hard data down the road.
And it seemed like this was a Fed more willing to say maybe it is a head fake with respect to the soft data and not necessarily emphasizing it as much as, say, the hard data, at the same time reducing their forecast. I wonder if we're making too much of the dots. I wonder if we're making too much of all of these utterances when essentially you have a Fed chair himself saying, we have no clue.
We don't know.
We don't know. Inertia. We kept it the same because what are we supposed to do? And so there is this element where you have to look at this and say, on a fundamental level, is monetary policy still in the driver's seat at this point? Or is this a fiscal policy-driven market and, frankly, an economically driven market that the Fed cannot really engage with in a constructive way?
So, Lisa, in moments like this, I wouldn't put too much weight on the forecast because the chairman is telling you we don't know. I'd put a lot of weight on the communicated reaction function, how they're communicating, how we'd respond to certain information points. And, Bill, I wonder what we've learned today. If we did get a deterioration in the economic data over the next several months, in the hard data, have we learned that this Fed would respond to that? Or would this Fed wait? Because I think that's critical for a lot of investors. Are they constrained? Is the easing bias now constrained by the inflation uncertainty of the next 12 months?
It's definitely constrained to a degree. I think the thing to focus on is the unemployment rate. If the unemployment rate stays where it is, then the Fed can wait. If the unemployment rate goes up to, say, 4.5%, then the Fed has to worry about the whole thing giving way. So I think the tightness of the labor market, how the labor market is performing, is really important. And that itself has a lot of uncertainty because, remember, the growth rate of the labor force this year is going to be much, much slower than it was in 2023 or 2024 because very little in migration. Deportations, so big slowdown in the labor force growth. So what that means is you can have slower growth and not have much change in the unemployment rate. So I think the unemployment rate is the summary statistic that I'd be focusing on.
I agree with that, Dr. Dudley. And my question is a 4.4, 4.5% U3 unemployment rate, is that the same as a U3 unemployment rate of 10 or 20 or 30 years ago?
No, I mean, I think the unemployment rate consistent with full employment has come down over time. Part of that's due to the aging of the population. Older workers are employed at a higher percentage of the time. So I think, the Fed's view is that we're basically at full employment right now, 4% or so. But if we go up to 4.5%, the Fed's going to be starting to worry that this whole thing is unwinding in a bad way. And then they'll be really assessing, is if inflation bad news transitory, or is it getting into inflation expectations?
It's difficult to say with that in mind, Bill, that this Federal Reserve is in a good place. Do you think it's in a good place?
Well, they're in a good place in the sense that the economy, the starting point for the economy is in a good place. They're not in a good place in the sense that they're being hit with shocks that are bad for growth and bad for inflation. And they don't really know what the policy is going to be yet. So I think they're not in good shape in the sense that, let's put it this way, they like where their car is sitting today, but they now have to drive down the road in a very big, foggy environment.